Welcome to Target Market Insights, the multifamily and marketing podcast. Each week, John Kasman interviews multifamily and marketing experts to teach you how to find the best places to invest, attract investors, and grow your portfolio. You are listening to Target Market Insights with your host, John Kasman.
Welcome to Target Market Insights. I'm your host, John Kasman, and I want to thank you for joining us for another great episode. If you're enjoying this podcast, I need you to do me a favor. Take a minute and leave us a 5-star rating and review. And if you haven't already, make sure you hit the subscribe button so you don't miss an episode. Now, today we're going to be talking to Holly Williams. Holly is the principal of keepmore.com and has been a real estate investor for over 20 years. Her active real estate portfolio includes rental apartments in Brooklyn, New York, single-family homes in the New Orleans, Louisiana region, and upstate New York, and passive investments in Texas, Tennessee, Florida, and South Carolina. Let's welcome to the show, Holly Williams.
So great to be here, John. Thanks for having me.
Holly, thank you for coming on. I know that you are running keepmore.com and you kind of started investing a little bit different, but you've been doing it for over 20 years. Can you talk to us about what led you to real estate investing 20 years ago?
Sure. So I got out of college, grew up in Texas. And, when you first start out, or at least for me, I grew up in a middle-class family. Mother was a school teacher. Dad was in HR for Sun Oil Company. And you fill out the 1040 EZ form, right? I didn't make any money. And I grew up learning and teaching. I was taught all about 401ks and, live below your means and all of those things. And so I did those things. And so for probably the first 5 years of my career, I continued to do that. Then I had an opportunity to move to New York, made a little more money, still wasn't crazy paying taxes, but I got to the point, I clawed and scratched my way up to the middle, and I got, some luck and hard work, and I began to have to write checks to the IRS. And it got worse, and it got worse, and it got worse. The more successful in my career I became, and all everybody said was, you're making money, so that's good. Well, I know today that it's not good. And I know today that, I read Rich Dad, Poor Dad, so I knew about the tax benefits of investing in real estate. So I did some of that, right? I bought a Manhattan apartment, bought a couple of single family homes, all of that. But when, I had a pretty demanding career, I was traveling a lot, and I really didn't dislike it. I was having a good time. I mean, being a corporate fat cat, everything's paid for. I could go to the Olympics. I went to a Super Bowl. I was having a good time. And so I was an early employee at AOL. I know I look like I'm 30, but I'm really, 57 years old. So I read Rich Dad, Poor Dad. I knew about it, but, it's all about the head, right? And I was programmed like most of people my age are, to having a job is secure. Your largest asset should be your home. Invest in the stock market. You're in it for the long haul. You're in it for the long haul, but yet the people that are telling you that are trading in 30-second intervals. So they're not following what they're telling you to do. And so 3 things happened about six years ago. Number one, I was on the board of the Texas Tech School of Advertising. Guns up. I went to the Tech. And there was a guy there that I became friends with. We were both younger than me. We were both interested in real estate. His name is Joe Fairless. So I knew him before he was famous. The second thing that happened to me was that I lost my parents in 2010 and 2011. And I watched them have to withdraw money from the stock market to live. Because you see, they bought into what we're told to do also. And, the whole idea that the government has, if you go to any retirement calculator, they tell you that first thing they ask you is, how long do you expect to be retired? The system is set up so that we die broke. They died broke, and not broke, but pretty, I watched them have a hard time. So that pissed me off. Second thing the third thing that happened was that, when you're beginning in your career, you get these, I'm saving money. I get these 1099s that say you made $10,000 or whatever. You give it to your accountant and that's that, oh, yay, I made $10,000. I got one that said, congratulations, you've made $65,000. And oh, by the way, in these mutual funds that my financial advisor had me in that were supposed to be no fees and all this stuff, I had to pay $25,000 in capital gains on top of all this other stuff. So by then I was married, I had a child, I made too much money to take any deductions, but I never made millions. This is what the big farce is. So there's the uber wealthy, and there are those of us who grew up with a map of the world and that we're doing everything that they tell us to do. And it just doesn't work out because we're listening to people that are not as wealthy as we are, that readily say, I don't know what's going to happen.
And Holly, you hit on a couple of key points there. I want to take a moment and debrief some of that because
I'm so passionate about this.
Yeah, no, you hit on some great things, right? You talked about your story and a couple things jump out to me. One, someone who really just clawed their way up the corporate America ladder, right? So coming in, working hard, getting promotions, earning those bonuses, those pay increases, living a lifestyle that you enjoyed. And as you were saying that, you took me back to a place maybe 8 or 9 years ago for myself when I was at, GM and living that kind of lifestyle, going to Super Bowl, NCAA championships and, Hollywood parties and all that kind of fun stuff and really enjoying life, but I think you realize to the point you were getting at is that as you talk about the finances, part of it is how much you make for sure. You absolutely have to be able to make money. But the other key is what you can keep. And that kind of started opening up your eyes and your mindset to say, hey, look, we need to look at other things and looking at your parents and their situation when they passed. And then really, coming across Joe and some of the things that he was doing at that time really opened up kind of your perspective to say, hey, listen, there are some opportunities in real estate. I want to go back to investing in some of the single family houses and apartments and things that you were doing, because there's certainly some tax advantages, but maybe a little bit different from apartment investing. Can you break that down for us?
Well, so the good news is, you can buy for appreciation and New York City, that's definitely what you do. It's almost impossible to buy for cash flow, but, I've saved $100,000 or something, or not even that. I saved enough, 30 grand, whatever I did. I bought a 1-bedroom Manhattan apartment for $120,000, $130,000 on Ninth Street and Broadway with a doorman. So, people told me, oh, you'll never get rid of it. This is the first thing I really should have realized, is that when everybody's telling you, all the people that are renting were telling me that you can never get rid of it. All the people that owned an apartment were saying it's a great time to buy. It's 1992, prices are down and interest rates we thought were low at that point. You see what I mean? We listen to people that aren't doing what we're doing. That's the whole thing. When I was getting my master's, I got a job offer. I had 6 months left on it. People were telling me, you don't need a master's, da-da-da-da-da-da-da-da. Those were all people that had 6 months left on their master's degree. I mean, seriously. All the people that had one were like, oh, you're stupid. Stay in school, finish it. It's 6 months. You've already done this much. Go for it. It's not going to hurt you. And it didn't. So, that's the first thing, right? The second thing is that I bought this, and it was a market where, honestly, I was paying about the same thing that I was renting, and I owned it, and I got some tax benefits. So it actually was a very good thing. Sold it because you can't rent it out. When I got married and I was pregnant already, I had to sell it to get the deduction of all the profits, but I sold it for $400,000, more than that, I think, or something like that. Yeah. So that's that. So I walked out of there with $400,000 in my pocket pretty much for 300. Anyway, so, along the way, I read Rich Dad, Poor Dad. I bought a couple of single family homes in Houston because you can cash flow down there. And the good news is I own 2 houses, at the end of the day. But knowing what I know now would have been a lot less work to just invest in a multifamily syndication. But I didn't have any idea because I did not grow up wealthy. The people that are really wealthy know all of this. That's why they're not paying taxes. They know all of this because the people that own multifamily are basically the ones that Goldman Sachs is buying them, A-Rod's buying them. All of these hedge funds, all of these private investments, a private investment versus a public investment. And there's a big, big difference in what you pay in fees and what you get at the end of the day.
Holly, explain more on that. So you talked about kind of these big companies are buying into multifamily syndications. And just for that person who is maybe they've got 50K or 100K right now to invest in real estate and they're debating buying a single family home or potentially a multifamily syndication. Can you walk us through some of the benefits?
Sure. So when you buy a rental property, there's a couple of good things about it, right? You can put in, $50,000 and you may get a $200,000 house and the appreciation goes up on $200,000 theoretically. You can write off so much. There's a thing called depreciation that the government lets you do. You got to remember that the tax code, think about it. The tax code is written for us to avoid taxes. Think about it. If we just if it wasn't, we wouldn't need it. We would just pay tax, right? We would have a tax on bingo. You make this much, you pay that much. The tax code is written for people to avoid taxes, not pay. So the tax code, they've written all this stuff into it about depreciation. And so when you buy a business, you buy a rental property, you can depreciate things that, the roof and park, everything, right? Because even though it may go up, probably will, they treat it as like you're a business and buying a computer. It's just the way it goes. So there were tax benefits galore. And so, but I made like $300 a month or something, maybe, because then the refrigerator would go out or whatever. And so, it's just a lot of work. It's just a lot of work. And you get some benefits early on, and then the benefits kind of go away because you're paying down the principal. But, I didn't really need the money. I was living on what I was making. So it was a good idea, right? So it was a good idea. Then I met a man 6 years into this, and he grew up in Brooklyn. And he grew up in Brooklyn, and he actually owned a 4-family house in Carroll Gardens, 1 block away from a really nice neighborhood in Brooklyn that was absolutely falling apart. He lived in another apartment. It was his family home. So I said, let's just renovate this baby and let's just live in the bottom. And that's what we did. And we never moved, which we probably should have. We should have done a lot of things, but, it was his family home. He doesn't ever want to lose it. But I'm sitting in it right now. Now I have a 15-year-old. And I'm in her bedroom. So I have an office, but I had a dental appointment, couldn't get there today. And so all of that. So, life is good, but, I was busy. And so that's the challenge with doing your own thing. The other thing that happens is that when you lose a tenant, you're down for the month, pretty much. So it's a lot riskier because with a multifamily, I've learned now that bigger is more, is safer. Bigger it is, the safer it is if you do it right. And I've learned how to do it right. So, I've seen, the stock market, they can't tell you what's going to happen, right? It's a total toss up. I can tell you with every apartment complex that I'm involved with, I can tell you exactly what happened in 2008, 2009, 2010. I can tell you exactly the risks. I can tell you exactly the things that we're doing to mitigate those risks. And so I feel like, it's just very simple. But again, our map of the world. So I feel like it's my duty, to try my best to save people from what my parents went through. That's really what I'm doing.
No, I love it. I love it, Holly. Can you talk? You were starting to talk about the single family, right? So you talked about the work that's involved, the risk when it comes from, even if you're cash flowing a few $100s a month, a refrigerator may go out and boom, you just wipe out your profits, right, for a couple of months at a time. You really don't know if someone moves out, that's all your money. You gotta, there's a lot of energy into getting a new tenant. If you're working with a leasing agent, you got to work with them. You might have to pay them commissions. So there's a lot of kind of capital, zappers that when you do your underwriting or your projections, you may think you're going to make, 12,000, whatever it is, $1,200, whatever that number is. And by the end of the year, maybe you didn't make that because you had various expenses and stuff that comes out. And we talked about some of the tax benefits. And I think you're getting ready to start talking about the benefits when it comes to multifamily, the predictability and understanding your projections. And obviously there's always some fluctuations with any investment,
Right.
But you were starting to talk about some of the benefits when it comes to multifamily investing as it compares to both the stock market as well as kind of a single family investment.
Mm-hmm. So it's a lot of work to find properties, right? And it's a lot of work also. What matters with multifamily, well, a lot of things matter, but what really matters to a passive investor is who's running the deal and what their mindset is. So there are conservative investments, there are investments where you need to go in and throw out deadbeat tenants and stabilize it, and you don't get any cash flow for the first 2 or 3 years. All of those things are fine. That's not my lane. So my lane is for cash flow. So if you're buying for cash flow and you want to mitigate risk, I do not want to lose money. I can't afford to lose money, right? And we gladly turn over our life savings to the stock market. I know nothing about Apple's, cost basis. I know nothing about what the trade agreement's doing, is going to do or did do or whatever. I know nothing about their business except for I have an iPhone and I like it. And they tell you, if you have an iPhone and you like it, buy stuff that you like. I mean, that's ridiculous. You don't know if they know how to run a business or not. So, that's the first thing. And so what I see now is people vetting syndicators, right? So, and they're an analysis paralysis, just like they were with single family homes. So these people are busy, and I was busy. Frankly, I invested because I knew Joe Fairless and I knew, I trusted him. And basically that's why people invest in my deals. But what I do is I help vet these things. So I go in and I only work with 3 or 4, probably 3 partners, and they all have the same criteria in mind. And so when I do that, and they're popular, right? So their deals all fill up in 5 minutes, right? So I make a commitment, and then I join their management team and I help with marketing and I, I go down and I do due diligence. I keep up with what's going on. I communicate with my investors, all that. So what happened was I became passionate about this. So I invested in a deal with Joe. Then he was new, right? So he needed somebody to sign on a loan. So I did that. He needed the first deal he did, second deal he did, he said, I need to raise $1 million. Can you help me? And that's when the light bulb went off, because I realized that not everybody knew about this. You see, I thought I was the only one that didn't know. When I got to New York, I called a friend. I said, oh my God, everybody here went to an Ivy League school. I went to this large state university. And she told me, she said, you know what? You ended up at the same place, didn't you? So just go with it. So it is what it is, right? And so I said, sure. So I started calling. I work with some pretty wealthy people, and I called my friend that sold his last company for $350 million. And I said, blah, blah, blah. And he's like, Holly, I lost money in a real estate deal, a few years ago. I'll invest in your startup if you want to start advertising, market research come, I'll you want a job here? What do you want to do? It's like, they didn't get it. And so that's what I'm amazed at. A lot of people, I grew up in Texas, right? So a lot of people think, oh, I want to be in control. See, it's a myth, right? We're never in control. You got cities that come up with laws that can affect your house. You got tenants that can trash things and not pay their rent. You've got storms and tornadoes that can blow the roof off, and all of that. If you're doing it all yourself, your risk is I'm sorry, but it's a lot higher if you do what I do to mitigate that. And so I invest in deals. I find deals I want to invest in, and then I offer them up to people I know and love. So, because guess what? The reason I didn't know about it, the reason people don't know about it, is because it's a club. It's a club. The wealthy know about it, but those of us who just kind of are successful don't.
Yeah.
And so I help people I know and love get into the club, because I had to take my husband to 3 accountants. He's like, we're going to jail. We're going to go to jail. You can't do this. Yeah, you can. So I put a lot of money in the first deal, and oh my God, forget it. It was great. And so it's cash flow that's tax deferred for the most part, if you do it right. And so I'm able to offset all those benefits that I got from single family homes, the depreciation, the tax. You can do that if you're a passive investor in a multifamily apartment complex. So I learned there's debt investing and there's equity investing, and you're getting a bunch of friends together and you're buying an apartment complex as opposed to invest. Basically, to get into one of these things, you really have to have a $20 million wealth management account with Goldman Sachs or Chase or whatever. People think, oh, I'm in private banking and all this. It's a $250,000 minimum to get in there. It's nothing. It's nothing. To really get into Chase's wealth management, you got to have 20 million, that is, not $20. So, there's a whole world out there. I thought these stock guys were making a couple $1 million. They're not. They're making 10, 20, $30 million. And that's what's happening. My daughter goes to school with all of them. So I was introduced to this world, and it was like, oh my God. So I grew up in Texas, and I have good friends that I love, that are like, I want control. I don't want to do this. And oh my God, I'm scared. Almost everybody, Holly, I'm only doing this because of you. And then they call me and they say, oh my God, you saved me $25,000 in taxes.
Well, there you go. And that's the benefit, right? I mean, we talked about some of the benefits of trying to keep more of the money that you earn, and
That's
some of the tax benefits.
All about.
It's so key. You hit on a couple things, and I think that there's a big barrier to overcome, because there is a big knowledge. It is a club. If you don't know about it, if you don't know somebody who can grant you access to the club, you kind of get to stand on the outside, and you may not even know what's happening, that this is going on. We talk to people all the time, and very similar to you, when I started talking to people in my network who I thought would be all over this, I got blank stares. I got like, dude, what? Like, no, I don't do real estate. It's like, no, that's, you don't have to do real estate. This is not you reading every single book and becoming a construction genius or anything like that. What it is, and you said it perfectly, it's pulling together a group of friends and going out and acquiring an asset together. You're going to get a loan from the bank for 70 to 80% of the value of the asset.
70.
Yeah, I prefer 70, 75, maybe 80 is a little higher on the low side, but yeah.
I have pretty strict requirements.
But you're going to get a loan from the bank for the majority of the funds. You're going to raise the rest of the funds with your friends and colleagues and people that you know.
You have to know somebody.
And that's where you're going to go in, and you talked about cash flowing assets, where you're going to make money from the beginning, the moment you buy the deal. We're not talking about highly distressed assets where you have to wait a year, 2, 3 years to start making money. We're talking about deals where you're cash flowing day one. And what you're doing is you're implementing a business plan that allows you to drive up the value, drive up the cash flow. We call it NOI or net operating income, but you're going to increase the NOI. And the way commercial properties are valued, the higher the NOI, the higher the value of the property. So that allows you to mitigate your risk because you're going in with a plan and an opportunity to drive up the revenue day one. So as long as you implement that plan, you're able to execute. Now,
Correct.
again, let's go. I don't want to go worst case, but let's just say you're not able to hit the numbers that you want. You still have a cash flowing asset that's still making money, that's still giving you the tax benefits that you're looking for.
Before we ever do a thing.
Before you do a thing. And I think that is the beauty of multifamily. And I know you and I both kind of do value add apartment investing. And that is really the benefit of that strategy if you're looking at it and doing it right. So Holly, you are now really helping other people. You've got keepmore.com as kind of a platform to educate other people. And I know that you are in the middle or almost towards the end of writing your first book. Talk to me more about Keep More and the book that you're creating.
So the working title right now is Keep More, Invest Like the Uber Wealthy. And it's going to be what I just talked about. And it's going to be how people like myself and like you can do it. And kind of our map of the world and how, a lot of it is just not true. And I don't think people are, I went to business school and they didn't tell me anything about this. I didn't know about private. It was all P&E ratios and all this stuff. That's all it was. And that's okay, because you know what? I know how to run a business. And at the end of the day, you need a plan, and then you need implementation of the plan. So I have friends that I love and I won't invest in their deals because they're not. I told a friend the other day, I said, why aren't you down in Houston? I mean, why did it take you 3 months to figure out that the management company sucked? I mean, that's just get the hell down there. Live in the model unit if you have to, but get down there. Manage this thing. So you have to have, I have to work with partners, and I certainly would be down there. And if I were invested in this deal, I'd be down there. And so I think that you really have to watch what you do, and people that put investors first, because first and foremost, I'm an investor. And I want people that are investors as well. So, when I got a 6-figure income where I was not paying taxes on it, you're kicking it down the road, but one offsets the other. So I'm going to talk about that in my book too. And just how if you make $200,000 in New York City, it's a $400,000 job. If you make, if you make $200,000, I may make $400,000 as my job. First of all, that doesn't last. Secondly, I'm paying $200,000 of it in taxes. And when you withdraw money, which you have to withdraw money from the stock market to make the money, which is crazy, you sell the golden goose. With this, you don't sell the golden goose. And so you still have that equity. You see, so if my parents had taken their $400,000 and put them in multifamily today, or even when they died, they would still have 16, 30. They would still have about 50 grand in income from it. But by then, because what I've done is invest, I lived on my W-2 job and then, so for $100,000 investment in how I do it, you're going to make $7,000 or $8,000 a year. You're not going to pay taxes on it, and you're going to have losses that more than offset that. So you're going to have losses that the new tax law, that's a whole other thing. But there's a thing called cost segregation. And so we're seeing 50, 60, so only 70% losses the first year. So you're losing money on paper. And this is how Jared Kushner pays no taxes. Warren Buffett, yeah, he's in the stock. I'm in the stock market too. But he bought 2 real estate companies. I mean, this is what's going on. A-Rod owns these things. So, half of the multifamily apartments in this country are owned by institutions. About the rest of them were owned by families. And so we're buying these things from institutions. We're buying from families that, they've had it for a long time. And Susie just wants her $20 million. She's in LA now and doesn't want to fool with it. So, those are the kinds of things that, that we look for. And it's all relationships with brokers and knowing how to run a business and doing what you say you're going to do.
Yeah, Holly, I want to hit on a couple of things you said there kind of quick just to make sure people are following and understanding. We talk about paper losses. So a paper loss, what Holly's talking about is you're going to receive the cash flow distributions, right? So the example you use was $100,000 investment. Let's assume it makes an 8% return. So annually, so you're going to get $8,000. But when it's time to file your taxes, if you do something called a cost segregation analysis, or you invest in something where there is depreciation and bonus depreciation, you're actually going to have more losses. So even though you have the 8,000 in your bank account that you made, when you go to report your income, you're going to report a loss. So that's going to reduce your tax liability. And that's one of the powerful things about investing in real estate in particular. But again, if you look at some of the tax reforms and some of the things that have passed recently, those are some of the real strong benefits. And that's why you see the uber wealthy, as you've so talked about. That's why you see them investing in real estate and syndications in deals like this, because it's not just the cash flow, but these tax benefits. You cannot get this investing in the stock market. So regardless of your current financial status, whether you're uber wealthy, whether you are middle class, whether you're starting out, it's something you should consider, because ultimately the goal is to keep the money that you make.
Right.
And you talked about avoiding taxes. I have a slight twist on it, but I think about it as the government incentivizes the behavior they want. And
Correct.
what they want is for us to invest in things like infrastructure and housing and business and really driving the economy. So the people who invest in the economy, the people who are hiring contractors, hiring property managers, hiring construction workers, hiring snow removal services. We are providing a real service that stimulates the economy. And by doing those things, the government has said, listen, if you do those things, you don't have to worry about paying taxes, or you can pay less in taxes. So they're really incentivizing the kind of behavior they want to see
Correct.
from Americans. And that's really what it is. So, I know some people look at it as kind of a bad thing and all that. It's not bad.
Not bad at all. And my book's going to talk about that.
Yeah, we're doing our part to drive the economy by stimulating it. And we are keeping the flow of cash going around and creating jobs and creating income. And that's something that we do. And again, I don't think many people give real estate investors credit for that. So I just wanted to kind of point that out, that again, it's an incentive that we get for stimulating the economy. And if you are serious about, driving things forward, it's another great way to engage and to, make a difference in your community.
Correct. And now you hit on the make a difference in your community. I mean, that's the other thing. When you're up in New York with a spreadsheet, you don't know that, man, they're dying for washers and dryers. And if you just get them washers and dryers, I went to the first one. It was a waiting list. A waiting list of like 75 people that wanted a washer dryer. We can call the Rent-A-Center or whatever and get a washer dryer for $15, and they'll pay $50 a month like tomorrow. Mm-hmm. And these are people that don't have $2,000 to go buy a washer and dryer. But they do it. They will, and it makes their lives better. Yeah. So we can do smaller things like that really, really, really impact what people need, and they're not building all the new constructions like really luxury stuff for the, it's Class B stuff that isn't. It's those working Americans that we target.
Absolutely. And Holly, I know most of your investments are more in the Southeast region, from Texas over to Florida up to South Carolina. Talk to me about kind of the markets you look at from a passive investing standpoint, and what are you looking for when you're selecting these markets?
So my background is market research, and this is all about demographics. It's all about what people are doing. And if you think about it, people are fleeing the Northeast like rats on a sinking ship, and especially New York, Connecticut. Their New York is growing, but you know what? The luxury stuff, the people with money are leaving, and they're going. Where are they going? They're going to Texas. They're going to North Carolina. They're going to, South Carolina. And the people up here where I live in the bubble that is New York, they don't even realize what's going on. They think that these people are down there with no teeth. Where are you right now?
I'm in Cincinnati.
Well, there you go.
I just left Chicago, so.
Right. And so you just left Chicago. So you're going south. and you'll probably go south some more. And so that's what's happening, is that the population is leaving and the companies are leaving. So if you look, I have a map if anybody wants to see it, about all the companies that have moved from, where'd they move from? They moved from California, they're moving from New York, they're moving from Connecticut, and the politicians don't seem to care. That's the whole thing. They really don't care, because they don't care about us. I'm convinced of this. They don't care about us. So we should care about us, which is another reason that Keith Moore is here, because the people making the laws don't care about us, and the evidence is everywhere. I believe that. None of them. And so they're trying to get reelected, and they'll do whatever they want, whatever they can. And I'm really convinced of that. And it's not political, it's just the truth. If anybody can refute that, let me know. But it's not what's happening. So starting a business, providing jobs, that is, that's, and being a good, looking out for your investors and trying to do the right thing. I hear people, it's immoral. You need to invest in the stock market. Well, that's not really wrong. What's happening is that if you don't, I'm in my daughter's teenager bedroom, right? I'm not in, when you start buying, in Manhattan high rises and going to Super Bowl, all the stuff that we do, you and I are paying for that. It may say 0.5%, no load fund, all this, but read those terms and conditions. You have to call them, and they're not even on the website, only a summary, right? It's like the transcripts, right? It's only a summary that's on there. So you have to call the Fidelity or whatever and get that thing. Forget it. The P&L is amazing. They're spending so much money. And so that is why the stock market may be making 35% and we're getting 10. And we're taught to think that our 10 is good. And that's on a good year, whatever. But, those bad years, if it goes down, 30%, it's got to go up 60 to be where you were. So if you take, one more thing, if you take my stock market example, my $65,000 gain that I paid I didn't take any money. I got no money in my pocket. So if you take that and say I put the same amount of money that was in that mutual fund into a multifamily, I would have had $8,000 if I took even if I took $400,000, let's say, $32,000 in my pocket. I would have had, like, for a $400,000 investment, I would have had $32,000 in my pocket, probably. Then I would have had losses of probably at least $500,000 that could offset any income, and it could offset, that's the other thing, I have a 4-family house in Brooklyn. We have other rentals. You could offset that. And if I didn't, you could carry forward those losses to when a time happened when I did. And that's exactly what I did, right? So, so the long and the short of it is, and then I would still have that $400,000 in equity.
Yeah.
So,
it's a phenomenal strategy.
$100,000 investment, man. And so you're not selling the goose to get the income. So it's the exact opposite from what we're taught to do. What it is find out how much money you want to make in retirement. And my daughter, when I die, people say, what's your exit plan? You're going to have to pay all those taxes. No, I'm not, because I'm going to die. And my daughter is now going to get, I want to be her. I'm in her bedroom, but she's going to, when you die, your heirs, all of that cost basis is offset. So if my parents had done that with the $400,000, I'd probably have $2 million, and they would have probably made $100,000 a year, tax deferred. They wouldn't have been paying any taxes. Instead, what they did, so I don't want anything like that to happen to people I know and love.
Yeah, Holly, I want to recap a couple things. From a market standpoint, you talked about following the population trends, going where the jobs are going, and that is really heavily in the Southeast region. Understanding politics, and it's not to be political, but it's understanding where are they creating business-friendly environments to foster job growth and job creation. You're seeing
Correct.
that big in Texas. You're seeing that in Florida. You're seeing that more in the Carolinas. There are places in the Midwest. Kentucky's doing a pretty good job of that as well. So Indiana as well as another state that's doing a pretty good job of that. So paying attention to those things. It's not about your political party
No, it's not.
affiliation at all. This is simply about where are people going? Where are the housing needs? In focusing on those areas because that's where the growth is going to be for the long haul. And I love what you're talking about in regards to stock market and the tax strategies because ultimately what we're really talking about here is generational wealth. We're talking about creating generational wealth and preserving the wealth and income that you've already created. So how can you take the hard work that you're putting in now, the money that you save, the money you put into a 401k or an IRA account, your retirement account, all of that hard work, the 40, 50, 60 hours a week you work right now for your job, for what? For just your house? No, none of us are doing, or at least no one I know is doing this just so they can have a nice house. You're doing this so you can live a lifestyle and so that you can take care of your family when you're no longer on this planet. And in order to do that the right way, you have to have a plan that is focused on creating generational wealth. Multifamily investment is a great avenue to do that because of all the tax benefits that Holly explained. But the biggest piece there is that you need to find a way to keep the money that you are already making, pass it along without having it taxed or without killing the golden goose. And that is the thing that multifamily allows you to do. And it doesn't have to be passively syndicating. There are folks who built their own portfolios, and that's certainly one pathway as well. I think the downside there is you have to do the work, you have to manage it, and you have to oversee all the aspects. But nonetheless, even if you don't care about real estate, that shouldn't stop you. I think everybody should be investing in real estate and in particular multifamily investing. And even if it's just a small slither of your portfolio, but to your point on the ability to take those passive losses and offset them against other passive gains, that right there alone is reason enough. And now, and if you're a doctor, if you're anyone who's a business owner, if you're a partner in your company, you're at a consulting firm, or you're a dentist, anything like that, you have to do this. Like you absolutely have, you are doing a disservice to your family by
Right.
not investing in multifamily. If you've reached that level of success and you're not investing in real estate at this capacity, you're really doing a disservice. And if you're listening to this, you can't say you didn't know because I'm telling you and Holly's telling you.
Exactly.
Now
So
you know.
three of my very, very closest friends, I finally said, look, I don't care if you do it with me or somebody else, but you gotta look at this, man. You're all in something. You know what I was told? You know what, Holly? I've done it right. I'm okay with my 4% in this annuity.
Oh man.
I'm okay with it. I've done the plan, and if it's 10%, I'm okay. And I just feel like I'm prepared. All
Yeah.
right.
I'll
Not
tell you one last thing. Not that you and I are just sitting here ranting now, but the other thing too is we talk about. You mentioned a few times earlier about listening to who's giving you advice, right? So if you're a renter, you listen to other renters, or you listening to other people who didn't finish their masters. The other piece here is a lot of people listen to their financial advisors, right, or financial planners, and a lot of these individuals, one, don't know about what we're talking about. Two, they're incentivized when you invest in the stock market because they get paid a percentage of whatever you invest in that fund. So just keep that in mind as well. When you're taking in advice, take all that in, do your own research by all means. Don't just go off what Holly and I are saying, do your own research. And certainly there are fees involved in it from a syndication standpoint. But the point is to understand where people are coming from, the decisions that are being made, and how you benefit. And at the end of the day, if you're doing this to take care of yourself, your lifestyle, and your family, make sure you fully understand what the options are on the table, because what we're talking about are powerful strategies that wealthy individuals have employed for generations and decades. And there's a reason real estate is so tried and true as a wealth building mechanism. So
True.
a lot of other things to invest in, but keep it simple to some degree.
I want to say one more thing about financial advisors, because I think that, I have friends. If any financial advisor, mine told me, Holly, you're making a big mistake 6 years ago, because that's all they know too, right? And they finished business school and they entered Merrill Lynch's training program, whatever they did, right? And they don't know any better, so they're not coming to work saying, I'm going to screw these people over, because they're not, right? They're really doing what they think is the right thing. And something, I still have money with these financial, I still, it's not, I don't put all my money into everything, but I have taken a substantial portion of it, much to their dismay. But you know what? I've told them this is, and they're like, this was a good deal for you. So, and they're doing some of the same things. You just don't know about it.
There you go. All right, Holly, we're ready to move on to our bullseye round. Are you ready?
Bullseye. I got to go. We got 5 minutes.
How has a failure or apparent failure set you up for later success?
I think that I know what not to do with multifamily, right? So I can protect the people I know and love, because I have invested in a couple of things myself. And what I've done is I've gotten to know, I know their kids, I know their dogs, I know people I work with. I know I do the work, right? And so I have some pretty stringent criteria. So call me and I'll talk to you about that. So I think that no matter how much I love the people, I don't work with them if it's not in my lane. I just really stick with what's in my lane. I think that the big failure that really impacted me was my parents. That's my only regret in life. It really is.
What is the book Right. What is the book you've recommended or gifted the most in the last year?
Tax-Free Wealth. Tom, what is it? Tom Wheelwright.
Tom Wheelwright. Yep.
Yeah, Tom Wheelwright. Tax-Free Wealth. He's a rich dad advisor. If you haven't read Rich Dad, Poor Dad, that's the thing that started the whole deal. But Tax-Free Wealth. And a lot of my book is going to be an offshoot of that. And a lot of it I learned from, none of this is a secret to the wealthy, because they've got the advisors. So listen to your CPA that has nothing in the game. Every CPA that I know has said, do this. If you know the people and you feel like with their plan, then these are good investments. Every single financial advisor, people come back to me and say, well, I'm not paying any fees. I'm in all no load funds. Yes, you are. You're just, yeah, you're paying. I'm only paying 1%.
You're paying one way or the other. Check out your CPA. That's Tom Wheelwright, Tax-Free Wealth book. All right, give me a digital or mobile resource you recommend for your business.
Oh God, I use the basic stuff. Excel, right? I use Excel. I use MailChimp. So I try to keep that simple too. I'm a simple person. I don't, what you see is what you get. I drive a Honda CRV. It's just not my thing. I don't want a big house, and I want generational wealth. And I've got that with my real estate and things that I do.
What is a daily habit that helps you stay focused on your goals?
I wish that I could get up in the morning and do the 5 minute, whatever it is, the millionaire morning or whatever it is. Just forget it. I slept till 8 this morning. Really, I just don't. But what I do is I try to plan the night before, and I try to, I have goals, right? I have goals that they're important to me. This book is important to me. My investors are important to me. So I take those high value activities and I prioritize them.
What's one thing you know now that you wish you knew when you were starting out?
Same thing, that the rich invest differently, and that if you don't, you need to really think about what you're doing. Think about what we're being told. The media is pretty powerful. And I was in advertising. They're spending billions to tell us things. And they're telling us things for everybody's got a reason for doing what they're doing. Find out what those reasons are.
What's one thing you know now that you wish you knew 12 months ago?
Oh, I think that just that the safety is not with the W-2 job. I quit my job last October. And oh, by the way, I want to tell you something that never occurred to me. You know when my birthday is? You'll never forget it now.
What?
April 15th.
April 15th?
I was born literally to do this.
There you go.
My birthday is April 15th. And so I think that just safety is the W-2 jobs is what's risky.
There you go. What are you curious about right now?
I think oil and gas. I grew up in Houston, so I think I'm writing 2 books. The first one is going to be about me and multifamily. The second one's going to be other alternative investments. You see, there's a whole bunch more stuff you can do too. And some of it's riskier than others, some of it notes. I'm learning about notes. I bought my first note where I'm, bought a loan. Just like banks, you see, you become the bank. And so I own this loan and these people are paying their mortgage to me. I own their mortgage and they're paying me $700 and something a month for a $42,000 investment. So if they default, I own the home. So there you go. We'll see what happens.
Love it. All right, Holly, give me the best place to grab a bite. And I know you're in New York. We can go with Brooklyn or you can pick the neighborhood, but you give me the best place to grab a bite in New York.
The best pizza in town, don't believe what you hear. It's a place on Court Street in Brooklyn called Sam's. And the guy is like, if you're old enough to remember Seinfeld, he's like the soup Nazi of pizza. He'll stand there like for 30 minutes. You only come in when he tells you to sit down, right? You only order, like, can I have some bread? No, it doesn't come with it. If I do it for you, I got to do it for everybody.
All right, we'll definitely make sure we check that out next time we're there.
I gotta tell you a funny story. This African-American couple came into this thing and they were standing there, and they got mad because they thought he was being like, and we said, no, come back. It's not anything to do with that. It's that he does this with everybody. We waited like 10 minutes. We waited like 15 minutes. There's nobody in there. Don't get offended. Just go.
Yeah, there you go. Don't be offended. That's just how he operates.
That's just Sam's. Gotta go.
All right, Holly, for our listeners who want to get in touch with you, what's the best way to reach out?
Keithmoore.com. My phone number's on there. Everything. There's some resources. This podcast will be on there.
Excellent. Keithmoore.com. We'll make sure we link to that in the show notes. We wish you the best of luck with all of your investments right now. I know you got your book going on. It was great talking to you, Holly. I hope you have a great day and we look forward to staying in touch with you.
Great talking to you too.